Something feels wrong when we talk about national debt. You've seen the headlines: 30 trillion, record deficits, national bankruptcy, yet countries keep borrowing. Every second, the US borrows roughly $40,000, and still, the debt keeps climbing. Why don't they just pay it off? By the end of this video, I'll show you the shocking but simple truth that makes the whole mess make sense, and why it actually keeps modern economies running. Most people think of government debt like a household problem. If you owe money, you should pay it back. That intuition is powerful, but completely wrong for a country that issues its own currency. If you run a household, you can't print money when bills come due, but governments like the US, UK, and Japan can. That doesn't mean recklessly printing cash, but it changes the entire game. Picture trillions of dollars floating over cities like balloons you can barely hold. That's literally how governments manage their money. John Maynard Keynes once said, "In the long run, we are all dead. Policy must work for the present, not some idealized future ledger. That's why governments borrow, to steer the economy today." Here's the core. Governments don't aim to pay off debt because debt is a tool that keeps the economy running. It creates safe assets, manages interest rates, and funds public priorities without crashing the system. If you thought your credit card was complicated, wait until you see what governments do with trillions. First, rollover, borrowing to replace borrowing. Governments issue bonds with different maturities. When one bond matures, they often issue new bonds to pay off the old ones. Think of it as refinancing a mortgage every few years. As long as lenders keep buying these new bonds, debt keeps rolling forward instead of being extinguished. Try paying it all off at once and chaos erupts. Taxes spike, spending collapses, the economy stumbles. Second, inflation and seigniorage quietly shrink the real value of debt. When prices rise, the burden of fixed-rate debt decreases. That's arithmetic, not magic. After World War II, many countries reduced massive debts through growth and mild inflation. Milton Friedman said, "Inflation is always and everywhere a monetary phenomenon. The right amount of inflation chips away at debt without default, but too much, and suddenly everyone's savings lose value, including yours." Third, the R versus G rule. Growth beats interest. Economists track two numbers: the interest rate on debt, R, and the economy's growth rate, G. If growth is higher than interest, the debt-to-GDP ratio can fall even while deficits continue. It's like running faster than your credit card interest accumulates. The debt ratio declines without paying a single extra dollar. Fourth, political incentives. Cutting spending sharply or raising taxes to pay off debt is politically toxic. Governments prefer gradual approaches. Borrow now, manage later. That's why headlines scream about debt, yet nothing seems to change. Let's look at real examples. After World War II, the US debt skyrocketed. Instead of harsh austerity, growth, mild inflation, and careful financial rules reduced the burden over decades. Japan carries one of the highest debt-to-GDP ratios globally, but low interest rates and domestic bond ownership let it roll debt smoothly. Greece, by contrast, can't issue its own currency, and when investor confidence collapsed, austerity and severe economic pain followed. Control of your own currency matters. This system works only if investors buy government bonds. Bond markets set the price, the yield the government pays to borrow. Spike yields and rollover becomes expensive. Crisis risk rises. Hyman Minsky said, "Stability breeds instability," meaning calm markets can breed complacency, until a shock suddenly increases borrowing costs. Governments must manage both the economy and confidence, with central banks stabilizing interest rates and backstopping markets. Recent tools make debt management even more flexible. Quantitative easing is when central banks buy bonds to keep borrowing cheap. Financial repression holds interest rates artificially low. Monetization is when a central bank directly buys government debt. Each tool seems harmless, but if it fails, everything changes. These strategies blur fiscal and monetary policy lines, explaining why high debt can persist without disaster. Modern monetary theory argues a sovereign currency issuer can never truly run out of money. Taxes and bonds aren't strictly needed to fund spending. Critics warn ignoring constraints risks inflation and credibility. But regardless, governments rarely pay off debt because it functions as a policy tool.
Friedman and Keynes remind us, manage the present, accept trade-offs later. What does this mean for you? Real returns matter. Inflation erodes cash value, so diversify into assets that track or outpace inflation. Policy shocks may affect prices more than default risk in your currency. Understanding why governments borrow helps you make smarter decisions about spending, saving, and interpreting the economy beyond sensational headlines. Bottom line, governments don't pay off debt like households do. Debt is part of the engine. It powers the economy, creates safe assets, and smooths crises. Paying it all off would be costly, disruptive, and unnecessary for modern countries. Next time a headline screams, "We're drowning in debt," remember, that's not the panic button, it's the engine light. The real question is whether the mechanic, the government and central bank, knows how to tune it. And stay tuned. In the next video, I'll show you 3 moves governments can make right now to quietly reduce debt pain. One of them is invisible to most citizens, and you'll be surprised how simple it really is. If this helped you see the system clearly, like the video and subscribe. More of this is coming.